Hello, my name is Jingonelli, and we're going to be continuing from where I had left off. But before I begin off, make sure you subscribe to the channel. So we had ended on the objectives of the auditor and the component of true and fair view. So with the objectives of the auditor of financial statements, the way it's written, it's the same way you will write it in the exam. So make sure you read the two objectives very well. There are two objectives of the auditor of financial statements, so make sure you read them. Then I'll go to the concept of true and fair view. So what does true mean? So true means that information in the financial statements is factual. It means that it is accurate and conforms with reality. For example, financial statements are free from material misstatement arising from fraud or error. And then the second one, the information conforms with the required FRSs and also the laws and regulations. Then the financial statements have been correctly extracted from the books and records. So the three move together. So make sure for information to be true, the three must exist, not one of them but all of them. So moving to what fair means, financial statements are free from bias, and also financial statements reflect the commercial substance of the entity's transactions. Then looking at true and fair view is the same as fair presentation, and for true and fair view, it does not clarify that financial statements are absolutely correct due to the audit limitations, which we are going to be looking at as we are concluding. Then it says here that a good auditor or a good auditor's opinion does not guarantee that an entity will remain a going concern. So the opinion in the audit report may be unmodified opinion or a modified opinion. So with unmodified opinion, it is the good report, and with the modified opinion, it's to do with it is a bad report. So with unmodified opinion, why it is a good report? It is because they detect no material misstatements, and the financial statements comply with the relevant IFRSs and the laws. So as you can see that this is issued when the auditor we have looked at the first one, and two, has collected sufficient appropriate evidence on the financial statements during the audit. So looking at the modified opinion, which is a bad report, this is issued when the auditor has detected material misstatements and financial statements do not comply with the relevant IFRSs and laws. And the second one has been unable to obtain sufficient appropriate evidence that financial statements are free from material misstatement, or which is called because of maybe a limitation on the scope of the audit. We shall look at this in topic 2. It will be topic 2 here. Then looking at the benefits and limitations of auditing. So benefits of an audit, they include it enhances the credibility of financial statements, as an audit is done by independent auditors. So since it is done by independent auditors, it will add credibility to an entity. The second one, it provides reliable information for decision making, like approving loans by banks. Then looking at the third one, reduces the risk of fraud and error, as regular audit leads to detection of errors and fraud. Then highlights deficiencies in the internal control, and auditors make recommendations to improve the system. So these are all self-explanatory points. Then it provides information in business acquisition, as audited financial statements are used to carry out due diligence of the business to be acquired. Then looking at the limitations, they're saying auditors cannot give absolute assurance, that is 100%, maybe it can be around 90% or 95%. And they're saying they cannot give absolute assurance that financial statements are free from material misstatements because of the following limitations. The first one, it is to do with the subjective judgment. This is because accounting estimates, so they just estimate involving management judgment. Since they have just estimated certain items like inventory, you would find that collecting evidence and forming an opinion also involves subjective judgments. Then the second one, the information which is provided is not complete. The saying there is the possibility that management and others may not provide complete information on financial statements requested by the auditor. You would find out that the figure for property does not include all that is supposed to be identified as property. So you find that certain things are left out, so hence giving incomplete information. So, and also limiting the auditing. Then we're having audit procedures used may not be efficient in detecting fraud involving sophisticated and carefully organized schemes to conceal it. So here you would find that the senior managers, they may be accountants, and they will easily conceal the fraud if at all it occurred, and auditor may not find and it will limit the auditor from detecting such fraud. Then we are having audit evidence. Audit evidence at times is persuasive and not conclusive, as business documents may be falsified. Here what they mean, the evidence, it is persuasive but not conclusive, in a way that you can be persuaded that the goods were delivered, yet they were not delivered. This is the example which we are looking at here. For example, the inspection of goods received note may not be proof that the goods were actually received. So here you're persuaded that they were received, yet in actual sense they were not received. Then the second last, it is saying an audit is not an official investigation. So they don't expect you to go to a particular entity to do an investigation, you as an auditor. Then we are having the last one, which looks at the need for an audit to be conducted within a reasonable period of time and at a reasonable cost, leads to auditors to use a risk-based audit. So what do they mean here? Because of a reasonable period of time, maybe they're given less time, and also the costs that may occur as a result of employing the auditors. You will find that auditors use risk-based audit in a way that you would find that they perform more audit work in areas expected to be with higher risks of material misstatements, and you will find that other areas are left out because they consider those areas to be having less risks of material misstatement. So they're saying here that auditors also use sampling. So you may find that they're just doing a certain sampling in a way that a certain portion is catered for more than the other portion. So that is to do with the risk-based audit. So that is that with limitations, and that is the end of topic 1. Make sure you subscribe to the channel. Thank you so much for watching.